Layoffs, hiring freeze, cost-cutting, a revenue slowdown coupled with a market sell-off. After a 13-year-long bull run, gloom seems to have set in as tech companies grapple with a floundering economic outlook. The winter everybody was alluding to finally seems to be here. Over the last few days, the world's largest tech companies have been saying sorry to their employees for firing them at a time when the conversation has firmly moved from managing growth to surviving a recession. From Meta to Twitter to Stripe and Snap, more than 52,000 workers in the US tech sector have been laid off, according to a Crunchbase tally, and more pain is expected in the next quarter of the financial year. Google, Apple, Microsoft and Amazon are tightening their belts as they reassess the market scenario. Startups have not been immune to the meltdown as funding has dried up. Global VC funding hit a 9-quarter low in Q3 with the largest quarterly drop in a decade as per CB Insights. The tremors have reached India as well, with funding falling to a 2-year low in the September quarter. In fact, Indian startups have also handed out pink slips to more than 17,000 employees so far this year. And the agony is palpable, with some on the startup street saying that 2023 could be a dot-com level bruiser, something that most young tech founders have not experienced. So what does the global tech tumble bode for India's startup economy, and what should the playbook be to take on what 2023 has in store? Hello and welcome to Young Turks, India's longest-running show on startups and entrepreneurship. I'm Shireen Bhan. Joining me today for our Voices from the Valley special from San Francisco, Priya Rajan, Managing Director of Silicon Valley Bank, Sanjay Nath, co-founder and Managing Partner of Blume Ventures. He joins us from New York. Meanwhile, Seattle-based Poole, co-founder and Managing Partner of Unitus Ventures and Capria Ventures, is currently on a visit to India. Priya, Sanjay and Will, thanks very much for joining us here on this special edition of Young Turks. Priya, let me start by asking you, and first of all, thank you to Sanjay and you for joining us. I know it's a very, very early start for both of you, and particularly you, Priya. You're joining us from San Francisco. The headlines are screaming tech austerity, tech crunch, tech winter. How bad is the mood in the Valley at this point in time?
Yeah. I just wanted to say thank you for having me here. Again, great to be here alongside my good friends Sanjay and Will. Just talking about the current market volatility, I mean, just starting with the long-term view that we have, that innovation economies will continue to grow globally and it will perform in aggregate. So I think we just need to have that in mind as we're kind of diving into this. The tech and life sciences are kind of facing definitely a significant headwinds with the volatile public markets. Here from US, the interest rate hikes that's happening, the war in Ukraine, the inflation, and the COVID that never seems to end, and kind of the associated challenges. What we're seeing in the next few quarters is likely to be bumpy, probably the hardest that we've ever seen for the innovation sector. Failure rates will likely be higher that we have seen in the recent years. The companies are continuing to and will focus on cutting costs, and the access to liquidity will be tighter. But one thing I do want to remind is this has been a historical trend in venture capital and the innovation sector during the previous economic cycle. So I think, we've been through a few of these and we'll get through this as well. So I just wanted to lay that as well.
Yes, it's important to have that perspective. And of course, that's exactly what we were talking about. Many young founders don't necessarily have the experience or the perspective of having dealt with a downturn, especially not a downturn of the kind that we are currently seeing. But Sanjay, I want to discuss one of the important issues that Priya spoke of. And I think Mark Zuckerberg spoke about that in his apology note to employees. When Zuckerberg says that at the start of COVID, the world rapidly moved online, there was a surge of e-commerce, which led to outsized revenue growth. And many people predicted that this would be a permanent acceleration that would continue even after the pandemic ended. I did too, and so I made the decision to significantly increase our investments. I got it wrong. I take responsibility for that. Sanjay, this is an important acknowledgement as much as it is an apology, because many people believe that the kind of changes that we saw through the pandemic was structural in nature, that we would never go back to work from office, that work from home was here to stay, that travel would never be the same again, that e-commerce would only continue to go one way, which was higher and higher. And a lot of those assumptions are being challenged and being tested at this point in time, Sanjay. How much do you believe the current pain is on account of just an overestimation of the structural shift that we assumed COVID had brought on?
Sure, Shireen, a great question, and thanks again for having us all on. One thing I'll mention is that let's all know that we are in a very cyclical and a long-term game in a business, right? We've seen, I mean, the industry itself has seen similar downturns around the turn of the century, around the Lehman crisis in 2007 and 2008. As we know, in boom times, there is a focus on growth, sometimes at the expense of. And when we look at the stage we're going through now, it is about belt tightening, and that's not unusual. I think Priya made an interesting point. There is one interesting way to frame it is that what you're building, is that a vitamin or a painkiller, right? So I'll just give you some examples. If you look at the SaaS side, I think we're seeing very strong continued focus on, let's say, cybersecurity and compliance, right? Just to name two examples. If you look at just pure collaboration, or I would say important but nice to have, there's certainly going to be either cutback or maybe plateauing of spending. On the consumer side, to answer your question, it's not going to be growth at the expense of. In one sense, we all sometimes, unfortunately, need this to return back to first principles and fundamentals. This is a return to fundamentals. We've been telling all our founders from day one that you should build to positive unit economics, regardless of what the market scenario is. And now it's not a nice to have, but you're forced to do that. So, Shteen, to answer your question, I think we've seen. I mean, winter is now not just figuratively, but geographically almost here. And I was just looking at one of the tweets that Hemant, my friend at Lightspeed, wrote, and I do agree with that, which is that the best are going to get separated from the good, right? Because you really have to come back to fundamentals, and it's not just focusing on growth at the expense of, but can you build to profitability? And we're also seeing the IPO markets reward that. The ones that are able to build to that and able to build sustainable standalone businesses will be rewarded.
You're right in pointing out that when the going is good, all boats are lifted. But at this point in time, as liquidity starts to dry up and you've got your back against the wall, it will be those who have focused on the fundamental, on actually building a business model that will be able to ride out the storm. But Will, you're here in India, so I want to understand from you, in terms of a pulse check, how different does the mood feel between what's happening in the US and what you're seeing here today?
Well, my perspective is actually across the 10 hotspots of tech across the global south, and that includes Bangalore, of course, and Delhi and Mumbai. And frankly, I've been waiting for this correction for 4 years, and I think it's a good thing for the market. It was just insane, as everybody knows. You couldn't hire people; they were getting paid up too much, and it needed to happen. And I was meeting with the founder here in India just last week, and he said, I asked him what I could do to help him, and he said, please help me find metaverse engineers. And I said, don't worry, Mark Zuckerberg will solve that problem for you next week. And he did. So we're seeing the same kinds of things play out across the other emerging economies. We're seeing slowdown, obviously, in the late stage, but we're seeing continued investment in the early stage. And in our case, here in India, 6 of our 10 best companies have actually raised money since the slowdown started in the last 6 months. So money is still flowing. There's record inflows in last year. 2021 is incredible. That money needs to be spent. Investors are going to spend it. They're going to spend it in larger chunks in earlier stages. They're going to spend it less in later stages. And obviously, people in the public markets are going to continue to suffer with the companies that were doing growth at all costs. Anybody that's not got with the program is going to suffer as well. They need to focus, as Sanjay said, on unit economics, on sustainable growth, and on path to profitability. And the entrepreneurs that do that well are going to be rewarded.
Very interesting point that you made there in terms of talent. I remember I was in the Valley through 2020 and 2021, and everyone was talking about getting onto a hotline with other founders just to be able to get one engineer. Talent was at their peak through 2021, and today we're talking about layoffs, we're talking about tech austerity, and as you mentioned, Will, 13%, that's the kind of number that we've seen Mark Zuckerberg lay off at Meta for the first time in the company's 18-year history. But Priya, I want to address the valuation issue. Public market volatility we've seen for the last few months now. They're clearly punishing just about everything at this point in time, irrespective of fundamentals. Masayoshi Son at SoftBank, while SoftBank is going through its own challenges, and we'll address that through this conversation as well. One of the things I found interesting that he said was, and I've heard this from other VC investors, that founders are yet to accept or come to terms with the valuation dynamics changing. They're yet to accept that. Are you still seeing that, or has there been a dramatic shift in the last few weeks?
I think there's a shift happening. I think there's a reality that's setting. I mean, I think 2021 was a kind of exciting year for a lot of things that has happened. You know, just to address what Will said, that was interesting. What we're seeing is like the deal activity that has across the stages is definitely showing more signs of distress. And I see there's a bar that showed that the early stage is lukewarm, that you said like a warm. You know, before we felt that early stage was not being affected, but we're seeing that impact kind of happen across stages. Now, the founders are feeling not just only at the late stage or, hey, IPO is kind of tightened out or not happening, but it's kind of across the entire, stage of financing. That's one. And you're seeing the VCs do have a lot of dry powder, but what they're doing is because they're having challenges in raising their next round and their LPs are holding them accountable and have a greater investment discipline. You know, those two are interconnected. So we're seeing that kind of trickle down to what the founders do. So fundraising is taking a little bit more longer time. And as you're obviously seeing, the VC investment totaled, especially in US, about 43 billion across, estimated about 4,074 deals in Q3. It's a 9-quarter low, as you had highlighted earlier as well, for deal value. And we're seeing this not just in kind of US, but we're seeing in LATAM, obviously India is being hit. We're seeing in Middle East, North Africa. So Q3 is starting to see a decline in early stage investment, which are typically impacted less by public markets. So now the reality is setting in with the founders that, you know, it is a new reality. So you need to kind of keep that in mind as you're kind of going through the burn or, you know, kind of planning for your next stage of growth.